What's up, gold miners? In today's episode, we welcome Lindsay Duguet to the podcast. Emergency physician turned real estate investor, syndicator, and educator. Over the last 5 years, Lindsay and her husband have managed to scale their real estate portfolio to over 600 units. And in this episode, we go over exactly how she did it. Early on in the episode, we go over Lindsay's journey from emergency physician into real estate investing and what inspired her to make that pivot. Lindsay and I also spend a lot of time talking about physicians, why so many physicians aren't investing in real estate, and why there's so many misconceptions and just overall lack of knowledge in the medical field, and what Lindsay is doing and Clover Key Capital, her real estate investment firm, is doing to help break the cycle and help physicians get educated on the powers of investing in real estate. And finally, in this episode, we spent some time talking about the importance of mentorship and why Lindsay feels she wishes she had started with a mentor sooner, and what you can do, some strategies that you could deploy to find yourself a mentor. This is a fantastic episode, whether you are just starting out in your investing journey, whether you're a little bit further along in your investment journey, and especially if you are a physician, you need to tune into this episode. So without further ado, everyone, let's welcome to the show, Lindsay Duguet. Lindsay, welcome to the Gold Mine.
Thanks for having me.
Yeah, no, honestly, this is it's been a long time coming. And as someone who's just tuned into this episode right now, Lindsay, they, we're like, oh my gosh, physician, now real estate investor. Why should they stick around and listen? Like, why should someone pay attention to this episode?
Yeah, good question. Honestly, I'm still sometimes surprised that I'm doing these podcasts with real estate. If you asked me 10 years ago when I was a medical student, I would have said, yeah, in 10 years, my goal, I hope to be a full-time physician with a family. Real estate wasn't even something that I was considering. And even 5 years ago, I had a pipe dream of having investment income that would cover my salary. Fast forward to now, that actually has happened through real estate, but I wouldn't have thought that that actually would become a real dream that happens. So medicine is very demanding. Medicine is changing. I think everybody should try to get other sources of income that they don't have to rely on treating their actual physical time for money, because that's exactly what a job is, right? You have to go to work to make a salary. So things like real estate, where you can actually get these investment streams, are very important for everybody. So stick around to find out how I did it.
Yeah, all right. Sounds great. Well, it's interesting because I don't know if you know this, but when I was undergrad, I was pre-med, and a lot of my friends ended up going, the distance, right? They went the whole way. And what's interesting to me is that, and I don't know if you share this same line of thought, but I feel like a lot of physicians, they become super book smart during the 10, 15 years that they're in school and everything. But the last 10 years, I've learned a lot about real estate and finance and how the world works, how money works. But I feel like a lot of medical students, because they're so engrossed in their studies, that you're kind of out in your mid 30s, early mid 30s, you've done with residency, and the financial literacy and the financial, a lot of medical students don't take the time to educate themselves financially because they're just so engrossed in the medical studies. Would you agree with that statement? Would you disagree with that statement? I'm really curious to hear what you have to say about that.
Yeah, I 100% agree with that. In medical school, even in residency, we're not taught anything about financial education. We're just racking up the loans in medical school. I mean, I came out with over $200,000 just in medical school debt. While you're working as a resident, you're essentially making minimum wage salary when you factor in the amount of hours that you're working. We really did not have financial education other than hearing about the other physicians investing in stocks. That's what we heard about, but it's not like we were taught. Yeah. It's just okay, you're a doctor, you hire a financial advisor, then you give them money, and then they just put your money into stocks and you hope that it grows, right? You invest in your 401, 403s and everything like that. And that's your retirement. You work, you invest in stocks, and that's it. There was nothing about real estate investing or any other type of investment at all.
So what was that moment for you? Because clearly you didn't follow that path, right? Mm-hmm. When did you kind of break free from that matrix?
Yeah, there wasn't one specific do or die moment that was incredibly pivotal or anything like that. My husband actually was the one that read the book, Rich Dad Poor Dad, which is the gateway book for a lot of people. Yep. And he said, hey, this kind of makes sense. Maybe we should look into possibly getting into real estate investment. And I am definitely a person that if something clicks for me, I will do everything in my power to get it done. So after I read it, I immediately signed up for a 3-day investment course. And we just started taking action from that day. Like as soon as we were done reading the book, we've been taking consistent action every single day for the last 5 years, which is how we've been able to balloon our portfolio in that amount of time. We didn't get stuck in that analysis paralysis phase that a lot of people get stuck in.
Well, and and again, this isn't like a rag on doctors thing, right? Like I have a lot of friends who are physicians, and so anyone who's listening to this podcast, like I have a tremendous amount of respect for people in the medical field. That being said, a lot of doctors are analytical by nature, right? They're
very much
the scientists, right? I was in a biochemical nanotechnology lab for like 3 years, pipetting stuff,
very analytical.
Right? So, yeah, 100%. So, I'm one of you, basically, in that, in that line of thought. But I'm curious, how is it that you were able to kind of buck that trend? Because I'm assuming that you also would probably consider yourself like at least quasi-analytical. And I feel like that's where a lot of, maybe scientists, doctors, that sort of like those types of individuals, engineers, right? They get stuck in this like analysis paralysis phase. How did you overcome that? Like it's
I think at the beginning, maybe kind of the stars aligned. We had nothing to really lose at the beginning. It's not like we had any big portfolio yet. Like again, I had $200,000 of medical school debt. I was just starting my attending career at that time. And the first houses that we bought, we kind of picked them out because we wanted them to be practice properties. So we bought 2 single family homes for $2,500 each and we renovated them. So we're like, okay, if we lose $5,000 plus some, $10,000 that we put into each house, it's not going to hurt us significantly in the long term. And we did have a lot of issues with those. If you listen to the other podcasts that I've done, but we got through it and we were just too stupid or too determined to quit. I don't know. But in any case, we kept going and we ended up making them work. And it's been that snowball effect since then.
That's awesome. That's awesome. So I also want to say this because I have noticed a growing trend, like in the last year, maybe, or 2 years, or maybe it's just because I'm more aware of it, but I am seeing more specifically physicians kind of, having these conversations about investing in real estate specifically. I think the stock market's always been there, that's kind of like the old school way of doing things. Maybe not old school, but like the traditional way.
Traditional, yeah.
Yeah. So what is it about is there something that's going on right now that like maybe the public isn't seeing right now in medical schools, or just maybe amongst like the medical community, like Instagram, Facebook, YouTube, like where is this trend kind of like emerging from, do you think?
I don't think anything has to do with any social media trend. It's really the day-to-day grind. Medicine is changing, and not just my specialty in emergency medicine, but I have friends in every medical specialty you can imagine that's out there, and we all feel the burn. We're being squeezed more and more for what we can give, and it's getting more documentation, and it's harder to get that FaceTime with the patients. And most of us went into medicine. It sounds cliche, but you want to help people. You want to take care of people. Right. And there's a trend just nationally toward more the bureaucracy of it and dictation and charting. And it's a tough environment. Even just, the years that when I started in emergency medicine versus now, it's like 4 times as hard to work in the shift as it used to be, just because of the patient acuity and the volume and everything to get by. So it's a tougher environment, and doctors in general are feeling that, and they want to have other areas of income that can either support themselves or that they can cut back so they're not full-time. I hear that time and time again. I have a lot of physician investors that have joined us in our real estate projects, and they don't want to quit totally. We've all worked so hard to get our medical degrees, but we want to do it on our own terms and maybe do it part-time or PRN, so you're not so burnt out in just the day-to-day. I have to go to work. I have to get this W-2 salary to pay everything.
That makes a lot of sense to me. And by the way, like I would say that exactly what you're describing right now is what I observed when I interned at a general practitioner's office back when I was like studying for my undergrad and everything, which is back in like 2011 or so, I think is when I did that. And even back then, the majority of his day was spent on the phone talking to insurance companies and not dealing with patients. And so at some point I just kind of like sat down with him and I asked him, I said, hey, so like what are you doing there all day? And he's like, I'm like fighting to like get paid, basically, right?
Yeah.
And so I know, and that was like over a decade ago. And if you're saying it's gotten way worse over the last 4 years, I can only imagine what the last decade and a half now really has done.
I hear that from a lot of specialists. I mean, luckily we don't have to deal with that in the emergency department because it's really, you're coming in, there's something emergent going on. We don't have to fight with the insurance companies, but for all my specialist colleagues or family medicine colleagues, it's tough. It's really tough.
Yeah, 100%. Well, so, you know, just switching gears a little bit, because obviously like there's light at the end of the tunnel for you because, you know, physicians still, you know, I would say like in this day, they still make good money. Right. And so you're making good money, but if the money's not working for you, then you're going to get stuck, you know, in this hamster wheel of, you know, having to work and, you know, living to work instead of, working to live or whatever, you know what I'm saying? Like, I don't know, I forget how it goes, right? But so now, you know, that you have been doing this, like how has your, you know, investing journey kind of like created freedom for you? I'm curious how that like has it happened yet? Has it not happened yet? I'm really curious to hear kind of like what it looks like right now.
On paper, we are financially free. Our investments and our portfolio, it can pay the day-to-day of our basic bills. It's not paying for, you know, any first class trips to France or anything like that to visit my husband's family, but it would pay the bills. However, that being said, we aren't doing that. I'm still working full time. In fact, I've almost gone the opposite. Now I'm the regional director of a couple hospitals in our system in the emergency department. Wow. So I'm like half admin, half still clinical seeing patients. So it's still full time. But we're using all that investment money and still money that we're saving from my W-2 to buy more investment properties. So we're really just building that portfolio right now. I haven't cut back or anything like that. My husband jokes all the time because he does our real estate portfolio full time. He has real estate professional status. He's out working with the contractors right now on an 8 unit that we just bought 2 weeks ago. So he's in it every single day. But he jokes that he doesn't get a salary because like our company doesn't pay him. We just reinvest everything. So he's always joking like I'm working for free.
Yeah, that's funny. Well, so that actually kind of answers my question because here I'm thinking is like, how is Lindsay doing all of this, right? Like she's you know, you're obviously working ridiculous hours, right? And then you're also a full-time investor. So obviously it sounds like your husband is an integral part of kind of like
he very much is. Yeah. Mm-hmm.
Yeah. That's awesome. So let's talk about the first deal. All right. You said there was 25, it was like 2 single family homes you said for 2,500 each?
D-class neighborhood, really poor condition, poor neighborhood, poor condition. Yeah. Too many lessons for those.
Yeah. So what was that like? Kind of walk us through that experience.
Yeah, we bought them sight unseen. After that 3-day investment course, I started signing us up for local meetups for free. So we met some other investors, and this guy actually, his wife worked at my hospital system too. And he's like, I've been doing this for 5 years. I have 20 doors. And again, 5 years ago, I'm like, wow, maybe in 5 years I'll have 20 units. Like it sounded like something that maybe could be reachable. So we ended up buying them from him because they were just too far away. And when we walked in, there were squatters in the one house, pipes were cut. There were like urine bottles all over because electricity wasn't working or anything like that. There were back taxes. Like we had done no due diligence on this, whatever. We just wanted to say, we're investors. We own investment properties now. So we also found a local contractor. We had no contract with him. We paid him cash up front. We did not see him again. So a lot of lessons on these properties. Everything we shouldn't have done, we did basically because we had no mentors. We were trying to do everything ourselves. We weren't talking to other investors. We were just, you know, you don't know what you don't know. So we kept them. We ended up rehabbing them. We found another guy to help with the project. We ended up doing full BRRRR, you know, the buy, rehab, rent, refinance, repeat. So we got our money back. They were infinite cash flow for the couple of years that we had owned them. We sold them. We got a duplex. Then we did some direct mail campaigns, got a 4-unit, got some single families in nicer A-class neighborhoods close to where we live here. Very similar, like got job renovations, did refinances on all of those. And then when we got to 22 units, we kind of reached our max. We realized we were growing, but not as fast as we wanted to. So we started looking at mentorships, mastermind programs. And that's where we really started to leverage other people's time, other people's knowledge. We never considered investing out of state. We had never considered investing with partners like a joint venture. syndications, like capital raising that I do now. Like none of this was even a thought a couple of years ago until we surrounded ourselves with other people who are much more knowledgeable in the real estate world than we are. And now we're doing all of the above and more.
That's awesome. So, and I think everyone who starts out investing in single families, I basically hear the same thing every single time, right? From everyone who's invested in single families and gone on to do bigger things, is that they realize at some point, after like 10, 20, 30, that like, wow, this is like doing it the hard way, and we're not scaling.
Not passive income, not at all passive.
Yeah. And we're not scaling as quickly as we'd like to. So let's talk about the scale. So what was the first like larger deal that you did, and how did you put that deal together?
Yeah, so it wasn't so large, but the first one that we did where it wasn't just Michael, my husband, and I, was an 8-unit joint venture out of state in Indianapolis. And we found that boots on the ground partner through the real estate group that we were in, and it's doing very, very well. It was, they called it a medium rehab compared to what we've done personally. It's really a light rehab. So we renovated those apartments, really just kind of changing the kitchens around a little bit. We reached our target rent, so we're getting consistent now, pretty passive income checks from that, since it's just set and sail at this point with it fully rented. We have done a 17-unit student housing with other partners that it's about 20 minutes away. It's doing well. We had some issues with the boiler the last couple of months. My husband was there on Thanksgiving Day, actually dealing with a burst pipe. So again, still some active, but doing well with that. So we've done a bunch of JVs. There's a hotel that we have in Fox Lake, Illinois. That was a huge gut job renovation project. Really nice area and a redevelopment part of the lake. So there's summer's the busy time. So we're getting into that busy time. And then we're doing the syndications too. So the first, I'd say, big project that we did with partners as GPs on that team was a 110-unit portfolio in South Carolina. And this was a LIHTC property. So it's a low income housing tax credit. And that was the value add here. It's in an area where it's more working class, but there's not a lot of options for people to live in. So this government funded LIHTC credit was coming to an end, and we are now able, and we have been for the last almost 2 years now, going in, renovating the units and then putting them at market rents. We were actually able to refi one of that portfolio part of the project. And it's doing very well. So that was our first big syndication project that we completed. That's
awesome. So there's actually a lot that I wanted to unpack from that. I'm curious. Yeah. So I'm curious, right? So you made the transition into syndicating properties, and you're currently raising capital for that. You're putting together your equity partners in there, your LPs. So what is it that you're doing right now to bring LPs to the table? Like, how are you raising capital? Is it primarily, fellow physicians? Like, what does that look like?
Yeah, it started accidentally, really, because people were hearing at the hospital about me, actually being now successful in these real estate projects. Yep. My husband calls it the unfair advantage, because a lot of people I work with, because they're physicians, accredited investors. So it makes it a little bit easy for some of the projects like 506C and even the 506B to raise money from the people that I know. We are doing more meetups that we're talking to people, trying to put out the education pieces too, because again, a lot of physicians were just not taught this. You don't know it's a possibility. You don't know it's even out there to do something like real estate investing. So it started out with people that I know and work with very closely in the emergency department. A lot of this has been word of mouth now. They've had, this project was going well, I'll reinvest, or they brought in other colleagues that they know, and we're starting, forming these relationships with them and giving them the education pieces. So it's kind of been a snowball effect in that way too. It's like, I actually am teaching, and I actually are helping other people. So now I'm enjoying that even more. Yeah. So I didn't think I would be involved in the capital raising aspect, and we don't do just that by any means. Like, we're very active in all the management of the projects and everything going on too. And my husband doing like asset management and that kind of stuff.
And that makes a lot of sense, right? And that's actually something that I think a lot of sponsors end up learning, is that, like, with accredited investors specifically, or like you kind of target the on the retail side of things, like the the individuals or the types of jobs that typically like you would expect them to be accredited investors. So like physicians are clearly one of them. I'm wondering, like, what was the conversation like when, you talked to some of your physician friends and kind of explained like the depreciation benefits of these syndication deals?
Yeah, I mean, that's huge for anybody. I mean, taxes are everyone's biggest burden. You look at your gross salary and then what you're actually taking home net, and it's like 40% is going right to taxes, right? So everybody wants to find the loopholes. How do you decrease your tax burden and everything? I'll be very transparent. I still do invest 100% in my 401, 403, 457. I have 529s for my kids. All of those decrease my taxable income. But yeah, the depreciation for real estate is huge. And people like me who have a high income W-2 and my husband has the real estate professional tax status, that helps even more for a lot of people. And I have a lot of physician colleagues where, they have the high W-2 and their spouses are now getting involved and active into their real estate. So it's like an extra legal loophole to take advantage of those depreciation benefits. And fingers crossed about if the 100% bonus depreciation goes back into effect. But we've, been educating people about that. We're in the 60% year right now, but it's still huge, and it adds up the more projects that you do. Yeah,
100%. I would agree that like getting that bonus depreciation back would be huge. And your spouse should get their real estate license or, the equivalent, like be involved in some capacity. So I did not know. So this is news to me that you are invested in a hotel, and I don't know if you know this, but that's what I do. So
I did not know that's mainly what you're doing.
Yeah. So let's talk about that real quick, because that's exciting. So did you acquire that as a part of a portfolio, or is this just like a one-off? You're like, this looks like a good opportunity. What does that look like? This
was a one-off. The boots on the ground partner that found this, he does a lot of seller finance type deals, which this is what it is. Like me, I like to send out letters and, trying to negotiate off market with people through direct mail campaigns. So he had found it through that. There were raccoons in the ceilings. It was essentially being used as a squatter house too. So this thing was in very, very poor shape, but the value add, he had the vision, he lives there locally. And he had the contractors in place and everything to turn it around. So we had trusted him through that to get it done. And the biggest lesson from this property, and I'll be very transparent, it was undercapitalized through the JV partners at the beginning. We didn't have the whole JV component. So it went slower than we wanted to at the beginning. So we could, kind of do one part of the project at a time until we got the rest of the money, and then continue to reinvest it. But we bought that in October almost 2 years ago. It opened officially last June. So we have a brewery, restaurant tenant in the bottom part of the restaurant. And then we have hostels type hotel rooms. It's called the RandolphHotel.com. It's very nice now. And then there's some, like in the winter, it's not obviously the busy season. So during that time, we convert the short-term rentals and the hotel units into mid-term rentals. So they're month-to-month leases. So we're still getting some, pretty decent income throughout the winter months. And now we're transitioning as of May 1st into the true hotel season where the money's made.
Yeah. That's awesome. And this sounds like a boutique then, not a branded hotel?
It is, yeah. It's very boutique, yep.
That's awesome. How many rooms?
21.
21. Nice. Mm-hmm. Awesome. And you said Montana? Am I making that up?
Oh, Fox Lake, Illinois. It's not too far from Chicago. Yeah.
Okay. I was like, how did I get Montana? That's crazy.
Oh, Montana. I'd like to have a ranch out there. That would be cool.
Yeah. 100%. Fox Lake, Illinois. That's cool. Yeah. I'll check it out. That's really exciting. So, any thoughts of doing more stuff in the hotel world, or are you kind of like, oh, that's nice, but sticking with multifamily?
I think you need to have it's really more of a business. I mean, any real estate is a business, but it's really day-to-day operations, which that was all new to us. And Michael, my husband, is very, very into that. And it's taking more time than we thought on a day-to-day to run that. So maybe if more systems would get in place, but my short answer is probably no.
Yeah. Okay. Yeah. No, unless you get to well, and honestly, like once you get into like the bigger, the branded stuff, right? Yeah. Hiring third-party management is definitely a possibility. I think, for 21 units, it's hard to make the numbers work. First of all, you can't even get a third-party manager to be interested because it just doesn't make sense for them, right? So,
And the scalability is not there for this one yet.
Yeah, 100%. We should talk offline, but it's interesting that you are at least invested in one hotel, and that's how it starts, right? You invest in one, and then eventually, yeah. So, anyways, in terms of your medical career, obviously you've learned a lot, you've developed a lot of skills. I'm curious what skills that you developed during your journey, or that you have developed over your journey, have you seen translate and positively into what all parts of real estate investing, whether it's, raising capital, syndicating the deals, just putting the deals together, whatever it is, like how has that impacted your real estate investing journey?
Yeah, that's a good question. I mean, both professions, it's about people, not just in different capacities. I mean, in the ED, I'm taking care of sick patients. In real estate, I'm taking care of tenants and taking care of investors' money. So there's, it's still a people business. Emergency medicine, it's really all about thinking on your feet. You're triaging sick versus not sick. You're doing it in a high stress environment. It took 11 years to become an emergency medicine physician, between college, 4 years, medical school, 4 years, residency, 3 years. And I kind of figured if I can learn to be a doctor, I can learn how to do real estate too. If I can learn how to buy and finance and manage a portfolio, we were able to do that. So real estate, it's more like triaging good versus bad deal instead of sick versus not sick patient. And, you do the paper underwriting just to see, is this going to be worth my time to even dig through further and going through more due diligence? It's like, in medicine, you're ordering CAT scans and lab work, and then you have to figure out that. In real estate, you're underwriting deals and seeing, is the insurance going to go up? What's the pro forma if I, increase the rents X amount over this amount a year? So it's analytical in just different ways. It's just a little less stressful in real estate because it's not real people's lives in the moment.
Yeah. 100%. That makes a lot of sense. And honestly, that's one thing that I really admire about physicians. When you really have to be ridiculously committed, right? Because you're dealing with people's lives and it's like on a daily basis. So the just like the overall mental toll that I feel like that takes on, like that has to take on you, right? Like I can't imagine that it's easy. Yeah. So I totally hear what you're saying about like having that like exit plan. Yeah. Right. And having that kind of like that safety net there so that you don't feel like the added stress of like, I gotta do this. Right. Yeah. But rather that's exactly
that safety net. That's a great way to put it. And that's what I feel now. Like I can go and do the medical administrative and medical clinical because I know, I've got student by law, if shit really hits the fan, I have that backup plan where I can, go just full time into real estate. So it lets me enjoy it more and put more passion into medicine when I am there, which is good. And I mean, it's all about time management too. It's so crucial to balance everything. And giving yourself grace in it is crucial too. Different days demand different levels of my attention. Some days I'm 100% medical director administratively. Some days I'm really just clinical physician. Some days I just need that mental break from that burden and I'm mom and wife only. And some days it's 100% real estate too. So it's a blend, and looking ahead at the week and kind of time blocking yet being adaptable is really key for making all of this work.
Yeah, 100%. So I'm curious, now that you've kind of gone through several iterations and evolutions in your investing journey, what does the current investment criteria look like for you?
So we will consider any deal anywhere as long as the numbers make sense, but more importantly, who's the team with. Michael and I, we're not doing things just on our own anymore. Like even the 8 unit that we bought 2 weeks ago, it's a very small JV. It's just 4 partners. One is my brother, who's into it. Nice. One is a very close friend who lives not too far away, who's also kind of boots on the ground, who's helping us. And then one is somebody who we know through our real estate networking in Florida. So, I mean, even with that, it's an 8 unit, but sometimes, some people count just numbers like, oh, I own 500, I own 1,000 doors, but they only own like 0.5% equity. Right. They're getting like maybe $100 cash flow a month. If that, it sounds great and sexy on paper, but it's not really doing a whole lot for your portfolio. So like this 8 unit, this thing is set to be a killer, right? But, it's only 8 units. So some people would overlook that, but we're trying to, always look at the big picture and who is going to be there on our team that can help us and we can help them too and leverage it. So that's the main thing. Partnerships, who we're working with is one of the key things that we're looking at right now.
How does one, and I have a feeling I know what you're going to say here, but I'm curious, right? Like, how does one find good partners for these deals? Like, where have you found these partners outside of your brother, right? Like,
yeah, so, he's stuck with me, right? He's blood.
Yeah, yeah.
Otherwise, it's networking, calls like this that then lead into like a conversation next week, the next month, and we don't just jump into, I mean, you're forming a relationship, right? It's like you're getting married to somebody, and we've had better partnerships than others throughout the years. And that has all been like growing and learning pains too, throughout that curve. So we want people who are ambitious. I mean, a lot of people think I'm crazy, which I am. Like, I do a lot. When I commit to something, I do it. And I have seen a lot of people, and not just partners, but potential partners that we didn't end up partnering with for these reasons, that the motivation isn't there. Every deal is going to have problems, right? Nobody has a crystal ball. There's going to be things that come up. You might find asbestos here or something like that, and then your numbers are shot for that month. Some people get very frustrated. They just want to bury their head in the ground and not deal with it. That's not the partner that I want. I want people that have grit and determination and a figured out attitude. So we're always looking for, there's a good book, Who Not How. Like, who is on our team that has different ideas and mindset, but still the same goal long term.
So, and this is just for my own personal like knowledge here. When someone asks you to partner, or you ask someone to partner with you, are you right now, focusing more on the equity side of things, like the capital raising side of things, or like the management side of things, both? I guess, like, because it sounds like you guys kind of have everything in-house already, like you have to do all this stuff. So I'm wondering when a partner would actually be necessary for you, if that makes sense.
So my husband and I have talked about that a lot, because he really does the hands-on management skills, and it depends on the deal for us right now too. Like the 17 unit JV, he really is the boots on the ground. He's managing it, getting tenants in there. We really have our leasing systems in place at this point, which is good. But for something like this, we're under contract and we're going to close in a couple of weeks on a 144 unit in Missouri. We are not the boots on the ground there. Our partners with Sharpline Equity, they have their in-house vertically integrated property management company there. So we're not using our property management on that one. We're using our partners. So different deals depend on different situations. We're close to getting under contract, hopefully on a 16 unit, which is right down the road from our primary home here. That one probably can do everything. I mean, we can bring in the partners ourselves. We can manage it ourselves. So we might not need a whole lot for that one. So it depends on the deal, the location, a lot of factors. So kind of like chameleons, you need to see what you need in which deal and to make it work.
That makes a lot of sense. I mean, especially if you're doing stuff out of state, you can partner up with someone that is more, boots on the ground, right? And then and with them, like in Missouri, the Sharpline are partners with that. They have all the broker relationships already. They own like thousands of units in that area. So we are leveraging them to get onto their team in that location versus, if they would come in on the 16 or something else, like we are more knowledgeable in this area here in Pennsylvania than they are. So yeah, it's all about the right partners. It really is. Makes a lot of sense. So let's talk about the market conditions right now, because obviously things are a little up in the air, and I'm curious what you are seeing, right now in the debt market. Like, what has that done to your deals? Has it slowed you down? Has it sped you up? Are you the same? Curious what that looks like for you. Yeah,
no matter what market cycle, we're always looking at deals. We're always underwriting, because sometimes you're going to have a lot more deal flow than you have money for it to buy. And then other times the deal flow is going to be down, but you can still find the deals. You can't just become complacent and say, oh, I'm going to wait another 1 or 2 years. Like, you're letting a lot of opportunities pass you by. So I mean, in 2023, last year, deal flow was down in general. Obviously the interest rates were going up. A lot of deals were not penciling out. But yet, especially in Pennsylvania, there were still a lot of out-of-state investors with cash, like from New York, who were still coming and buying up these properties. We essentially couldn't compete because they were buying them cash just to park their money. Meanwhile, we're buying it to make sure like the cash on cash return is okay. And what's the IRR? What's the EM going to be? And we couldn't compete with their numbers, right? So yeah, we missed a lot of deals, but we also weren't just buying things to say we bought something. Like, we're not going to be dumb about spending our money and the other investors' money, right? Now, we're really starting to see a lot more of the stressed sellers with bridge debt coming due. And With the interest rates being high, the underwriting that somebody did a couple of years ago, it's not working out for a refinance or a sale price that they thought that they were going to get. So like even this 144 unit, we literally had to sign a paper with the sellers that we can't publicly say out loud what we're buying it for, because they're a big institution and they don't want their reputation ruined. But they got in the same situation with this one. So it's happening. It's out there, which it's good for us because we're getting better deals now. Going into Q2 of 2024, we're pretty excited, actually.
Yeah, I would echo that sentiment. I mean, it's an exciting time to be a buyer for sure. Not an exciting time to be an owner with a maturing loan.
Yes, exactly. Yes. Yeah. Very well said. Yeah.
Yeah. So question for you though, because obviously you've been investing for some time. Are any of your properties right now kind of like, are you experiencing that on the owner side of things at all with any of your loans? And how are you overcoming that?
I mean, thankfully, no, we are not.
Nice.
The only one that is a little stressful is actually that hotel one right now, again, because of the undercapitalization from the beginning. But that's just on, a couple JV partners that we don't have any other investors' money to worry about. All the syndications that we've done and everything, we are, again, knock on wood, thank God, like everything is okay right now, which is good. We don't have any hard money loans coming due or bridge debt or anything like that. So.
Yeah. So question for you, your first syndication, right? For someone that's like, oh my gosh, like I want to, like, I've been investing for a little bit. I want to syndicate, but I don't know like what to do. How did you do your first syndication? Like, did you bring in someone that knew how to, administer like fund administration, like already had that experience? Yep. Did you guys just kind of like, okay, you did. All right, cool.
Yes, we did. We didn't find a deal and just say, okay, let's try to make this work. Michael, who can we bring in? We were brought in as part of the team from other experienced people who had done multiple other full cycle deals, which is what I would recommend to anybody. Don't jump in and because you don't know what you don't know. Like you need to leverage other more experienced people's knowledge with a good track record. 100%. That's my personal advice.
Yeah. That makes a lot of sense. So you had mentioned something earlier that I wanted to touch back on now, which is you had talked about broker relationships before. And I know that in previous podcasts that I've heard you on, you've also mentioned this, like how have broker relationships kind of like, or how has like leveraging broker relationships helped you along in your investing journey? And what advice could you give someone that's starting out that wants to kind of grow that?
Yeah, having good broker relationships, it's invaluable. I mean, we have bought everything just through broker, like pocket listings from people that haven't even hit like LoopNet or the MLS. It's from that track record and constantly reaching out to people and saying, hey, we're here, we're still here, we're still looking for deals, and also giving them feedback. There have been so many times broker sends us deals where the ask price is just astronomical. So we underwrite it and we say, okay, your list price is, or what you're saying that a seller wants is $20 million. Yeah. We're at 14.5 and this is why, because of this debt service and here, and a bank won't accept these long terms. So even if we're saying no, we want to give feedback because it helps broker, it helps the seller. And you also never know if, deals fall through all the time. So say that 20 million seller ends up accepting 18 and then they don't close. And now they're closer to their INO being due or something like that. And now they are a distressed seller and hey, maybe they will reach back out to you on your 14.5 offer. So giving good feedback to the brokers is very huge too. Don't just ghost people or say, oh yeah, it's too high, it's not worth it.
Yeah. No, and that makes sense, right? Like, it's interesting because prior to getting into hotels, I was a broker as well. Residential, not commercial, but it's fascinating because like how you are treated so this is something that like people don't understand, right? Like most brokers are really treated like, there's like, they're just, oh, that's a broker, right? Like they're not really given like a ton of respect. At least that's what I found. And so it's interesting whenever I hear someone say, hey, like you should really like nurture those relationships because it's true. If you try and like, build a relationship with a broker, chances are you're going to get a lot of preferential treatment in return,
They might advocate for you more too. I mean, if they know that you can close too, they can help push the seller, maybe closer to your price point too. So you want good relationships with them.
Yep. Yeah. So question for you, when it comes to the next 24, 36 months, there's still a lot of economic uncertainty. There's still a lot of, obviously this is an election year, that sort of thing. So what's your outlook right now, Lindsay, on the next 24, 36 months? And how can investors prepare themselves for what's coming ahead? Obviously you don't have a crystal ball, right? But like to the best of your knowledge, right?
Take it out and shake it.
Yeah.
I mean, there's not a lot changing in our strategy right now. I mean, we're still, like I said, looking at deals. We're still optimistic. We might not buy, and we're not rushing to buy deals too. Like if nothing is working out, we know that there will be more deals. You don't want the fear of buying a deal now just to miss out on a better one to stop you. There's always going to be more deals. There's always going to be a reason why a deal isn't perfect either. Like there's no perfect deal out there. So we just want to continue to be consistent at looking at deals, underwriting deals, providing feedback, and moving forward with any that hit our target and making sure we're operating those well too. You don't want to just keep buying to say you're buying and then forget about the deal that you just bought and you're not operating it correctly, right? So that's a lot of the strategy too. You need to be paying very, very close attention to the deals that you do have to making sure you're hitting your target returns for your investors as well, or yourself if it's a JV.
Yeah. And how are you accounting for that in your underwriting, right? So like, obviously we don't know where the debt market's going. I think everyone is assuming right now that it's going to go down over the next, 2 years or so. But can you really say for sure that that's going to happen? So like, how do you account for that in your underwriting? Do you have like a best case, worst case scenario system or what?
Stress testing the underwriting. And to be very transparent, my husband really is the underwriter. He is a mechanical engineer by background from France. Like he is the Excel file guy that I say, okay, I think this is going to be okay. And then he pulls up and says why this is wrong or this is right. Or, you need to have another 5% buffer here and all that kind of stuff. So we like to have buffers in everything. Like, okay, if we think that we can get $1,200 rent because of what we've had from this property down the street or something, maybe we just put it at $1,100 instead of pushing it, to the max. If especially on pretty much everything we buy, there's some type of value add construction that we're doing. So if we think it's going to be $50,000, we're putting $75,000 in the underwriting,
right?
Just as an example. So there's buffers for every part of it. If we think that we can refi at 8.5%, we're going to put 9.5%, something like that. So if we miss the target on this part, then we have buffers here and here. So that's how we try to underwrite everything going forward with deals. And that's why we get beat out by some people too, because maybe we are too conservative, but we want to be respectful and protecting our money and everybody else's too. Yeah.
The game changes when you have investors, right? Then all of a sudden it's not
you're
just
the fiduciary. Yeah, exactly.
It's not just your money anymore.
Yep.
Obviously, you've learned a lot of lessons in your real estate investing journey, and I'm curious, and this has made you all the wiser. But if you had to look back on this journey of yours, what would you say is a pivotal mistake that you made that you learned a lot from? Like, what is maybe the biggest learning lesson that you've had in the last however many years you've been investing now?
Yeah, I mean, the biggest ones probably came from that first project. Just do due diligence, even if it's a cheap deal. Make sure you don't waive the inspections, get inspections done, always have contracts with everybody. Like I said, that first contractor that we had no contract, don't pay people everything up front. Most of the deals that we do now, like I said, they have some type of renovation, and we actually have banks finance up to 100% of the construction projects, which is great. And then they give it to our contractors in draws. So, nobody's getting everything up front. They're getting it as the project is progressing. But that's another thing we talked about, broker relationships, but bank relationships are just as huge. So relationship building is huge. I think that we should have focused more on that at the beginning. Like I said, we were getting these deals without talking to anybody, no mentors whatsoever. We could have saved a lot of time, mistakes, and money had we been working with other people to help guide us from the beginning.
This comes up in almost every podcast that I do is, at some point in the conversation, we talk about mentorship and we talk about, the power of great mentorship. You've touched on it already, but, I'm genuinely curious, like what mentorship you have, like, where did you find your mentor? Did you find them like online? Is this like a guru type of situation, or like did you just like organically find them? I'm curious, like what the path was for you to find this person.
Yeah. So the first hired mentor we had, it was through that 3-day real estate investment course, like way back, 5 years ago. And we ended up paying like $20,000 because we were sold in the moment to this guru course. And what a waste of money. We got almost nothing. We got more from the 3-day, like $2,000 course than the $20,000 course. So that sucked. Wow. It wasn't worth it. The biggest one that we have gotten a benefit from, it just over $9,000. It's Make It Happen Mastermind. And it's with Sharpline too. So we've now partnered with them, and we're on their team actually as like employees now too. So that one was huge. But there's other physician only ones that I'm part of that are just free, that we just talk to each other. It's more of a accountability group, I'd say, for other syndicating physicians, which is great. So you don't have to pay a bunch of money to be in a mentorship. I mean, there's plenty of people that I know, even personally, that they just like to, they're in their 70s, 80s. They've been very successful. They just like to talk and give back knowledge and nuggets and stuff. So, but that again, get out there and network too. You don't have to pay somebody $20,000 that you're wasting on something that you're not getting the value from. So it's, I don't know, kind of interview your mentors and see who's a good fit for you, because it's just like a physician relationship. A good doctor for one person is going to be a bad doctor for that, somebody else. So it's all about the relationships.
Yeah. And it's interesting that you say that, because I think that there's something to that, right? Like not all mentors have to be paid. And one of my previous guests, Cody Davis, he has and Christian Osgood is his partner. They have like a really, I don't know if you've ever met them or talked to them.
Oh, yeah.
Yeah. So they're out on the West Coast. So, they had this really interesting strategy. I don't think they ever paid for mentorship, but basically what they did was they just call every multi-unit, like every apartment complex in the area. And they don't say, hey, I'm looking to buy. They say, hey, I admire like the portfolio that you've built. I'm getting started in real estate investing. Could I buy you a cup of coffee? I'd love to learn more about how you did it. Right. And so they start building these relationships with the sellers or with these owners. Right. And then all of their deals have been seller financed, and almost all of them have been like 0% down.
That's amazing.
Yeah, they've built these relationships with sellers, and I just think that's brilliant, because like, obviously they're leveraging kind of like their youth, and they can kind of put on like that inexperience, like, oh, I'm a puppy kind of thing, right? And help me but it's
awesome.
Kind of,
but most humans, they like to give back, right? Like that's just the intrinsic
100%.
nature. It's funny you say that, because on this 8 unit that we closed on, I mentioned there's 4 partners, and one of them is a close friend now who lives pretty close to us. Years ago, he reached out to my husband that way. He literally said, hey, I Googled like Luzerne County real estate investors. Your name came up. Can I meet you for coffee? And now this guy's on a JV deal with us like years later. So it's exactly how it worked.
That's awesome. Yeah. Well, it does work, right? Like,
it does.
Yeah, that's fascinating. Well, Lindsay, we're coming up on time here. I want to be respectful. But, before we finish up here, I'm curious if people want to, either look into partnering with you, investing with you, where can they find you? Obviously, all the links will be in the description below. Where can they find you?
Yeah. So our syndication website, it's cloverkeycapital.com. Behind me up here. We actually have a mentorship, me and my partner, Lauren. It's called mindshift2millions.com. So that's the mentorship. Clover Key Capital is the syndication. And then I just put out content on Facebook, Lindsay Duguet on Facebook. It's at doc.duguet for Instagram. And I reach out to I respond to anybody who reaches out to me too. I have a Calendly. You can book just networking calls. I love to talk about real estate. Clearly, I'll just go on tangents and talk for minutes at a time. So
that's awesome. That's awesome. So, well, in traditional gold mine fashion here, actually, before we do this, I'm really curious, right? What is the significance of Clover Key? Like, what is that?
Of all the people I talk to and podcasts, nobody's ever asked that. That's a good question. So my husband's from France. So we have the fleur-de-lis. I love to find 4-leaf clovers. I have thousands and thousands. Basically, every time I go outside, I find a 4-leaf clover. So that's the 4-leaf clover in the middle. And then the key is for real estate. So yeah.
That's awesome. Okay, cool. I was just curious. I was like, all right, Clover Key. It's got a like good, like catchy name. So I was like, oh, that's a good one. I should ask her about that.
We put a couple of the French, the clovers, and the house key together.
There we go. I love it. In traditional gold mine fashion, Lindsay, we're going to have you leave the audience with one final Gould nugget.
Just start. The compounding fact, it is such a huge thing that we didn't realize until now we're in it. you're going to wish you started today, a year from now, if you don't start. The more that you put consistent action steps, whether it's calling a broker every day, whether it's investing in one deal a year, it will add up over time. So just start and be consistent.
Love it. I couldn't have said it better myself. Lindsay, thanks for stopping by.
Thank you very much.